Good evening. We begin tonight with a development in the commodities market that has captured the attention of traders, investors, and financial analysts across the globe. Silver, a precious metal that has traded sideways for extended periods in recent history, has crossed a significant psychological threshold, breaching the $100 per ounce level. This milestone represents more than just a numerical achievement. It signals potential structural shifts in a market that many observers had dismissed as stagnant or manipulated for years. The move occurred amid what market participants describe as extraordinary volatility and unusual trading patterns. Unlike previous price increases that quickly reversed course, this particular advance has demonstrated persistence, raising questions about whether the traditional dynamics governing silver pricing are undergoing fundamental change. The timing of this development, coupled with broader macroeconomic uncertainties and shifting industrial demand patterns, has prompted a reassessment of silver's role both as an investment vehicle and as a critical industrial commodity. For context, silver has spent multiple decades trapped beneath key resistance levels, creating widespread skepticism among market participants. That prolonged period of disappointment conditioned an entire generation of traders and investors to expect failure whenever silver approached major price milestones. The psychological impact of that history cannot be understated. When markets break through barriers that have held for such extended time frames, the subsequent price action often defies conventional expectations, as previous resistance levels can transform into new support zones, and market sentiment can shift dramatically. The current environment presents a complex picture. While the headline price movement captures immediate attention, experienced market observers emphasize that the underlying dynamics matter far more than any single day's close. Several factors appear to be converging simultaneously. These include potential short covering in futures markets, where traders who bet on declining prices face mounting losses and must exit positions regardless of cost. There are also indications of tightening physical supply conditions, particularly evident in premium structures across different geographic markets. Additionally, sustained industrial demand driven by electrification trends and solar panel manufacturing continues to absorb significant quantities of silver, creating structural deficits between production and consumption. Understanding the distinction between paper markets and physical markets proves essential in this context. Paper markets, dominated by futures contracts and financial instruments, allow for significant leverage and speculative positioning. Physical markets, by contrast, involve actual delivery of metal, and participants in those markets often behave quite differently. When paper prices and physical prices begin diverging, with physical metal commanding premiums over benchmark futures prices, it suggests underlying stress in the supply chain. Recent reports indicate such divergences have appeared, particularly in Asian markets, where physical premiums over New York benchmark prices have reportedly widened substantially at various points. This geographic dimension adds another layer of complexity. Traditionally, price discovery in precious metals has been dominated by Western trading sessions, particularly in New York and London. However, observers note that recent significant price movements have increasingly occurred during Asian trading hours, suggesting shifting patterns in where demand originates and where price pressure concentrates. When Shanghai pricing carries consistent premiums relative to New York pricing, it indicates physical buyers in those regions are willing to pay above benchmark levels to secure actual metal. Such premiums cannot persist indefinitely without eventually influencing global price structures, as arbitrage mechanisms and physical flows work to reduce gaps over time. The industrial demand component deserves particular emphasis because it distinguishes silver from purely monetary metals. Silver serves critical functions in electronics manufacturing, solar panel production, automotive applications, and various other technologies essential to modern infrastructure. Recent data suggests industrial consumption has reached historically elevated levels, with solar panel manufacturing alone accounting for hundreds of millions of ounces annually. As global electrification accelerates and nations pursue renewable energy build-outs, this industrial demand base appears relatively inelastic, meaning it continues regardless of price fluctuations, at least in the near to medium term. Meanwhile, supply response mechanisms in mining operate on vastly different time frames than financial markets anticipate. Bringing new mines into production requires extensive lead times, often measured in decades rather than years, particularly in jurisdictions with complex permitting processes. Published research indicates that average development timelines from discovery to production can exceed 15 years globally, with some regions experiencing even longer delays. Existing mines face natural depletion over time, and maintaining production levels requires continuous investment in exploration and development. When prices rise sharply, the immediate supply response is typically minimal, as producers cannot simply accelerate output at will. The combination of stubborn supply constraints and resilient demand creates conditions where markets can experience sustained tightness. When futures market positioning becomes heavily skewed in one direction during such environments, the potential for forced liquidation and rapid price adjustments increases substantially. Market participants using leverage find themselves particularly vulnerable, as adverse price moves can trigger margin calls that force position closures regardless of longer-term views. Such forced buying or selling creates momentum that can feed on itself, producing price action that appears disconnected from fundamental valuations until the positioning imbalances resolve. This brings us to a critical question facing market observers today. Does the breach of the $100 level represent an anomaly, a temporary spike driven by technical factors that will quickly reverse? Or does it signal the beginning of a more sustained repricing, where silver establishes a new trading range that reflects tighter fundamentals and changed market psychology? Historical precedent offers limited guidance, as previous breakouts occurred under different macroeconomic conditions and market structures. What appears increasingly clear is that dismissing the move as insignificant risks, underestimating forces that may prove more durable than conventional wisdom suggests. The road ahead remains uncertain, but the pieces on the board have shifted in ways that command attention and careful analysis. To fully understand the significance of recent price action, we must examine the mechanics underlying silver markets and how leverage interacts with physical constraints. The concept of a short squeeze, while frequently mentioned in financial media, deserves careful explanation because its implications extend far beyond simple price volatility. In essence, a short squeeze occurs when market participants who have sold assets they do not own, expecting to repurchase them later at lower prices, instead face rising prices that force them to buy regardless of cost. This forced buying accelerates price increases, which in turn forces additional buying, creating a self-reinforcing cycle that can produce dramatic moves in compressed timeframes. Silver markets have historically accommodated substantial short positions, particularly in futures markets where leverage allows participants to control large notional values with relatively modest capital outlays. When prices remain stable or decline, such positioning appears prudent and generates profits for those betting on lower prices. However, when prices begin rising sharply, the mathematics of leverage work in reverse. Losses accumulate quickly, and when those losses approach or exceed available margin, exchanges and clearinghouses require additional collateral or forced position liquidation. These forced liquidations manifest as buy orders that must be executed at prevailing market prices, regardless of whether those prices appear rational or sustainable. The magnitude of open interest in silver futures provides context for understanding potential squeeze dynamics. Open interest represents the total number of outstanding contracts that have not been closed or delivered. When open interest remains elevated relative to readily available physical inventory, it suggests a large volume of paper claims exists against a more limited pool of actual metal. Under normal circumstances, this arrangement functions smoothly because most participants close positions financially rather than demanding physical delivery. However, if confidence in the paper market erodes or if physical tightness becomes apparent, the ratio of paper claims to physical availability becomes a source of instability rather than efficient price discovery. Recent market commentary has highlighted instances where participants have encountered difficulties securing physical metal at prices close to futures market quotes. Premiums charged by dealers for coins, bars, and other physical forms have reportedly remained elevated even as futures prices climbed, suggesting strong underlying demand for tangible assets. This divergence between paper and physical pricing represents a stress signal that market observers monitor closely. In well-functioning markets, arbitrage mechanisms typically keep paper and physical prices tightly aligned. When sustained premiums emerge, they indicate either logistical constraints preventing efficient arbitrage or fundamental imbalances between available supply and committed demand. The geographic distribution of these premiums adds further dimension to the analysis. Reports from market participants indicate that Asian markets, particularly in China and India, have at various points exhibited premiums over Western benchmark prices that exceed typical ranges. These premiums reflect local supply and demand conditions, regulatory factors affecting import and export flows, and cultural preferences that influence buying behavior. When premiums persist across multiple markets simultaneously, it suggests global tightness rather than localized disruptions. The interconnected nature of modern commodity markets means such signals cannot remain isolated indefinitely as physical flows and capital movements work to equalize pricing across regions, albeit with lags determined by logistical realities. Industrial demand patterns provide fundamental support for higher price levels that purely speculative factors cannot sustain alone. Silver's unique combination of properties makes it irreplaceable in numerous applications, despite ongoing efforts to find substitutes or reduce loadings per unit. Solar panel manufacturing exemplifies this challenge. While technological advances have successfully reduced the quantity of silver required per individual panel, the exponential growth in panel installations worldwide has kept total silver consumption for solar applications at elevated levels. Published industry data suggests solar sector silver demand has reached several 100 million ounces annually, representing a substantial portion of total global supply. Electronics manufacturing presents similar dynamics. Silver's superior electrical and thermal conductivity makes it the preferred material for numerous applications where performance cannot be compromised. While manufacturers continually seek ways to economize on precious metal content, the ongoing proliferation of electronic devices, the expansion of data center infrastructure, and the increasing electronic content in automobiles all contribute to sustained industrial offtake. These demand sources prove relatively price inelastic in the short to medium term because redesigning products and qualifying alternative materials requires significant time and investment. Industrial consumers typically absorb higher input costs rather than halt production while pursuing substitution strategies that may take years to implement fully. The supply side of the equation reveals constraints that prevent rapid responses to higher prices. Silver production comes from two primary sources: primary silver mines, where silver represents the principal economic product, and byproduct production from mines primarily targeting other metals such as zinc, lead, copper, or gold. This byproduct nature of much silver output means that global silver supply depends partly on economic conditions and operating decisions in entirely different commodity markets. If base metal prices decline and mines reduce output or suspend operations, silver production can fall as collateral damage, even if silver prices remain strong. This linkage creates supply dynamics that do not respond straightforwardly to silver market fundamentals alone. Primary silver mine development faces the same extended timelines that characterize all mining projects. Discovering economically viable deposits requires extensive exploration programs with high failure rates. Once discoveries occur, years of additional work follow to define reserves, complete engineering studies, secure financing, obtain permits, construct facilities, and ramp up to commercial production. Industry research consistently documents that average development timelines from discovery to production span well over a decade globally. In certain jurisdictions, particularly in North America, regulatory and permitting processes can extend these timelines significantly further. Some analyses suggest average development periods approaching 3 decades in the United States specifically, reflecting complex environmental review processes, legal challenges, and community consultation requirements. These extended development timelines mean that today's supply additions reflect investment decisions and exploration successes from many years prior. Conversely, today's investment decisions and exploration efforts will not materially impact supply until the next decade or beyond. This fundamental disconnect between price signals and supply response creates conditions where commodity markets can experience prolonged periods of deficit or surplus before production adjusts sufficiently to restore balance. The mining industry cannot simply accelerate timelines when prices rise because the regulatory, technical, and financial hurdles remain constant, regardless of commodity price levels. Existing mine depletion adds another complicating factor. Ore bodies are finite resources that deplete over time as mining progresses. Even well-managed operations experience gradually declining ore grades as the highest quality material gets extracted first. Maintaining production levels requires continuous investment in exploration to replace depleted reserves and in development to access new ore zones. When commodity prices remain depressed for extended periods, exploration budgets contract and fewer new deposits enter development pipelines. The consequences of such underinvestment manifest years later when production from aging mines declines and insufficient new supply comes online to offset those losses. The silver industry experienced exactly this dynamic following the price collapse after the previous cycle peak, when reduced exploration spending created a pipeline deficit that persists today. The interplay between these supply constraints and the leverage embedded in futures markets creates conditions ripe for volatility. When fundamental tightness coincides with speculative positioning that anticipates lower prices, the resulting forced repositioning can produce price moves that appear disproportionate to incremental news flow. Market participants accustomed to stable conditions struggle to process such volatility, often interpreting it as evidence of manipulation or market dysfunction rather than as natural consequences of structural imbalances meeting leveraged positioning. Understanding this dynamic proves essential for maintaining perspective during periods of extreme price movement and for distinguishing between temporary dislocations and the beginning of more sustained trends. The current moment appears to represent exactly this type of inflection point, where multiple forces converge to challenge established price ranges and test the resilience of existing market structures. This brings us to a critical question facing market observers today. Does the breach of the $100 level represent an anomaly, a temporary spike driven by technical factors that will quickly reverse? Or does it signal the beginning of a more sustained repricing, where silver establishes a new trading range that reflects tighter fundamentals and changed market psychology? Historical precedent offers limited guidance, as previous breakouts occurred under different macroeconomic conditions and market structures. What appears increasingly clear is that dismissing the move as insignificant risks, underestimating forces that may prove more durable than conventional wisdom suggests. The road ahead remains uncertain, but the pieces on the board have shifted in ways that command attention and careful analysis.